Hello and a very warm welcome to you. I'm Natalie MacDonald and you're watching another Sydney Direct. Global FX markets were shocked by the SNB's decision to remove the Euro-Swiss franc floor. To get a look at how this is impacting Australian FX markets, I spoke to Lewis Cooper, MD of OANDA Australia, here on Sydney Direct. Lewis, thank you so much for taking the time to chat with us. Now, to say that last week's move by the SNB shocked markets would perhaps be a little bit of an understatement. Walk us through this move by the SNB as OANDA saw it, really.
Thanks for having me, Natalie. I think the biggest thing is it was a shock. The market was completely taken by surprise. And I guess if you have a look at what the analysts are saying after the event, no one's blaming the SNB for what they did, but I think the timing of it and the fact that they actually contradicted the actual event the previous week by saying that they were committed to the 3.5-year strategy, I think has completely shocked the market. And what happened when you shock the market like that is when the event occurs, there is absolutely no liquidity in the market. And essentially what did that mean for OANDA and our clients is our clients were seeing a price, they were executing on that price, and as we were hedging out into the market, there was a lot of slippage because our liquidity providers weren't providing those prices. And that's because our liquidity providers were just as shocked as the retail investors. And it's unfortunate, not only the timing of the event in terms of no sign of the event coming, but also the fact that the SNB decided to make the announcement during a relatively illiquid time. They could have waited until the US session for deeper liquidity. So as well as the shock factor, there was also not a lot of liquidity in the market, and that's created a knock-on effect. And it's had a huge impact on the market. It truly is a Black Swan event.
Now, you talk about this sort of knock-on event. How did OANDA respond to this? What facilities did you have in place?
I think it's important to say, really, and I've been asked this question a lot over the last few days, is can you preempt these events? Can you know that these events are coming? And I think this is a great case of no. No one saw this coming, very few people anyway. And I believe in those instances, a company's duty to itself and its client base is to make sure that you're prepared for significant market moves. And OANDA, we have very significant risk management policies in place. We test and stress test our client portfolio regularly against really big market moves. And I think that's a responsibility of any financial institution to do that. So when these events occur, even if you don't preempt them, you know that you have the right level of capital in place to manage these events. So we were well prepared in terms of our risk management strategy. Another important point to make, I believe, is that we only offer up to 100 to 1 leverage and only to a handful of clients. Most of our clients trade around 40 to 50 to 1 leverage. And there are providers out there trading, allowing their clients to trade at 400 to 1,000 times leverage. So if you're highly geared in the market and then suddenly a currency pair moves by 30%, in a very short time space, then if you're very highly leveraged versus your deposit in your account, then that's going to create a massive deficit. And that's why we've seen with certain providers and institutions big negative balances across their global client base. So we weren't as exposed in terms of our client exposure, so we were able to manage that more effectively. And finally, OANDA, we hedge most of our business, so we only have a small risk book, and we have very, very intelligent risk management systems with low latency. So when the event occurred, we hedged out into the market extremely quickly, and we did hedge at a loss. We weren't completely unscathed by this, but I think the amount of slippage was limited by the fact that we do have extremely good systems in place to manage our hedge.
As you said, there are some providers perhaps faring not quite so well. What are the implications then moving forward? Are we likely to see greater regulation and further fiscal implications for some brokers?
Yes, I think it's inevitable, to be honest with you. I think looking at some of the providers globally, that big global businesses that haven't actually managed their capital requirements based on their global regulation through this event, I think there's going to be more focus and a review of people's risk management strategies, and with a focus on having enough capital to manage stress events such as the ones that we've seen in the last few days. I also believe that there possibly will be a review in some markets around the maximum leverage available to a retail investor. We've seen that, with very high gearing products, that some investors were overgeared at the time this happened, and it's caused a lot of pain for certain retail clients. I think there may be a review in that in markets where that hasn't already happened. So, for instance, in Singapore and the US, there are already limitations on leverage. I also believe, specifically to do with the Australian market, that this is a great example of why you need to fully segregate client funds. In this situation where clients are in leveraged positions, and unfortunately, when big events like this occur, some providers do become insolvent and go out of business. We saw it with not exactly the same scenario with MF Global a couple of years ago, but when those businesses become insolvent, the problem then becomes if they've used client funds for hedging purposes or other ppurposes, there's a chance that when that business goes insolvent, that clients lose their money, even if they weren't in positions related to the event. And I'm hoping, as all the members of the Australian CFD and FX Forum, that this is a catalyst for change, and we finally see in Australia full segregation of client funds, as we see in most mature regulated markets around the globe.
We've spoken a lot then about FX brokers, but what also does this mean for FX traders themselves? Has trust in central bank rhetoric been blown then, really? And furthermore, could we see further Black Swan market events this year, do you believe?
I think there's been a worrying trend over the last 3 months. So, some central banks such as China, Japan, and now the Swiss central bank have gone off script a little bit. And that's not necessarily the case with other central banks, but because that's happening in recent months, that people are starting to have a distrust in what the central banks are saying. I think that's an extremely dangerous trend, and no one wants to see that progress. So I think we need to see the central banks restoring faith in their communication strategy because of what happened last week. I think people are expecting possibly the central bank saying one thing and actually doing something else, and that is why we had such a surprise last week. There are some other big events that are going to happen this year that could move the markets. We have the UK elections. We have a possible rate hike in the US, and as we've seen here in Australia and in France more recently, there's an ever-present terrorist threat. But I don't believe that any of these things are going to have the impact on a single trading day that we've seen. But it really depends on the central banks and how they communicate moving forward. And we're all hoping that they learn from the mistakes that were made by the Central Bank of Switzerland.
The Dukascopy TV team will certainly be keeping you updated on this story as it unfolds. For now, though, it is goodbye from me.